Herzlich willkommen bei unserem Format Fonds im Fokus. Heute beschäftigen wir uns mit dem Thema Infrastruktur für die moderne Welt. Infrastrukturinvestments wird ja ein defensiver Charakter nachgesagt. War das tatsächlich während der Corona-Krise so? Diese und andere Fragen stehen jetzt im Fokus. Dazu darf ich als Gast Alex Araujo von M&G, zugeschaltet aus London, herzlich begrüßen. Herr Araujo hat über 25 Jahre Kapitalmarkterfahrung und ist seit 2015 für M&G tätig. Das Interview führt Richter, Senior-Analyst. Er ist seit über 15 Jahren für FondsConsult Research tätig und beschäftigt sich bei der Selektion seit vielen Jahren unter anderem mit Themenfonds. Hiermit darf ich an Sie beide übergeben. Ich freue mich auf einen regen Austausch. Bitte sehr, please.
Thank you, Mr. Schmidt, and a warm welcome to Alex Araujo from M&G. About the defensive characteristics of infrastructure, we will talk later. So please let us start with some general introduction about infrastructure as an asset class. Obviously, infrastructure is more than toll roads and railways. So what do you mean by the term listed infrastructure, and why do you consider it a separate asset class?
Well, thank you for that. And I would start probably by highlighting the diversification within listed infrastructure, especially as our economy and society continues to evolve. We invest in the traditional economic infrastructure, which is utility businesses, energy infrastructure, transportation infrastructure, as you mentioned. But we also invest in social infrastructure, very critical infrastructure assets to the functioning of society, such as hospitals, schools, medical facilities, and so on, and even universities. And we finally invest in a very important aspect of infrastructure, which is the evolving infrastructure component of our strategy, investing in digital infrastructure, without which none of the services, the digital services that we enjoy, whether for entertainment or for work, especially now, when many of us are stuck at home, we wouldn't be able to do. So those digital transactional infrastructure assets are critically important as well, and all of them are very different.
So you have segmented the universe into three classes: social, evolving, and economic. Are you able to give us an example for each class so that we have a better understanding about which kind of companies we are talking about?
Of course, and all investments are listed equity instruments. There are no private companies. These are all companies with key physical infrastructure assets as part of their portfolio listed on mainstream exchanges. Within economic infrastructure, perhaps I'll give you a couple of examples. One would be renewable energy businesses, for example, offshore wind farm developers, such as a Danish company we've had in the portfolio for a very long time called Ørsted. I would also perhaps give you an example of an energy storage terminal business that stores or transports energy products as a critical infrastructure component of today's economy. Within social infrastructure, I think the most important and current example would be hospital infrastructure or care facility infrastructure, and perhaps even educational facilities. And then finally, in communications infrastructure, one of the most critical assets that we have in that aspect of our strategy would be data centers, which are enormous structures that house all the communications and processing equipment and servers that are critical to an increasingly digital economy.
At the end of the day, how big is your investable universe? And do you exclude any companies, for instance, because of EG considerations or because of its market cap?
Yes, our investable universe is very deep. It is 260 companies roughly, with a total market capitalization of $3 trillion US. So we have a huge number of businesses and sectors around the world across which we can invest. And at any given time, we would own between 40 and 50 companies out of that investable universe. So it is very deep, it crosses many sectors, and it's global.
And your fund was launched in October 2017, and there are a lot of other infrastructure funds available already. So what is special about your approach?
Well, we have three very important differentiating points. The first one I will address is to your question, the ESG element of the strategy. And you did ask about exclusions. We do specifically put very strict limits on our coal-fired power exposure, of course, very relevant to you in Germany, and also nuclear exposure, also very relevant to you and to other countries. And we do that for sustainability reasons. We feel that those kinds of assets are at a higher risk of becoming stranded in the near to medium term. So we put specific exclusions there. And our ESG process is very much oriented to this asset class. It is specific to infrastructure, taking into account the risks, the considerations that are specific to the asset class, specifically around the long-term nature of the assets, and being sure that we don't lose the license to operate those assets, that we don't find ourselves with stranded assets, and that we can extract cash flows for a very long period of time. So that is the first aspect of what we do that I feel is differentiated. The second is our distinct focus on growing cash flow streams with a view to growing the income that our unit holders receive every year in euro terms. This is critical for us. And I mention it because most people think of infrastructure investing as a high yield strategy. And the yields are attractive. Currently, the portfolio has a yield of roughly 4% gross before tax, but it's the growth in the income stream that attracts us, and that's where we spend much of our time. And then the final differentiating feature of the strategy is the breadth across which we invest, specifically investing in social infrastructure and digital infrastructure businesses, specifically, as I mentioned earlier.
But doesn't lead your focus on growth and less so on stability and yield? Does this lead to a portfolio that has higher volatility and higher drawdowns compared to classical infrastructure funds?
It's possible. It depends on the market and it depends on the circumstance in any given moment. We are investing for the long term, and I firmly believe that we cannot generate outsized returns in the equity market without seeking growth. The growth that we seek is manifested in the growing dividend streams that we receive from our companies. That makes them very defensive in nature because they're very stable revenues, stable cash flow generators, and they grow those distributions over time. So compared to the broader market, this strategy, even with its focus on growth, does have more defensive characteristics and lower volatility over the medium to longer term, without question. We obviously have episodes where that may change, and there will be times when an extremely defensive portfolio might have a brief period of outperformance, but I think the strategy has proven itself over time through various different market episodes and phases that it demonstrates those characteristics exactly as you mentioned.
So when you construct a portfolio, is there some kind of neutral allocation or a benchmark that you look at?
We try to avoid being obsessed by benchmarks. It's one of the reasons we chose not to use an infrastructure benchmark. Many of them have the wrong kinds of exposures. They don't invest the same way we do. They don't represent or resemble what we're trying to achieve in this strategy. So we chose to use the broader equity market, the MSCI All Country World Index, as a benchmark. And because of that, and because there are so many areas where we don't invest in global markets, we don't have to be obsessed with it. What we are seeking is outcomes. We seek to deliver a premium yield to the global equity market by way of higher dividends to start with. We seek to grow the income stream to our unit holders every year in base currency terms. And we seek to do all of that with lower volatility than the broader market and a lower drawdown than the broader market. Those are our objectives. And it means I don't have to think much about the benchmark or be obsessed about the benchmark, because many global investment managers, the first thing they look at when they get up in the morning and they go to their screens is they ask themselves, what did Amazon do overnight? What did Apple do overnight? And am I overweight or underweight? And for us, that's not the way to invest. These are infrastructure businesses we're investing in to access the long-term growing cash flow streams from the underlying assets.
So you have been the manager of the fund since inception. Have you been involved into this asset class before then? And can you give us some insights into the infrastructure expertise of M&G in general?
Yes, I've been obsessed with infrastructure for a very, very long time. People call me an infrastructure geek, and I don't mind that. I've always been fascinated by the opportunity in businesses like utilities, when most people see them as boring or defensive and uninteresting. They have been drivers of very strong structural growth by way of renewable energy deployments and other areas that are accessing the energy transition, which is so important to us today. We first started investing in listed infrastructure businesses roughly 13 years ago when we launched our global dividend fund. We were investing in high quality asset-backed businesses with growing dividends. They happened to be listed infrastructure businesses. And what we observed as we then went through the global financial crisis was many of the characteristics these types of investments demonstrate, which I've discussed. Their lower volatility, their stability, their growing dividends despite the economic backdrop. And that gave us the idea to launch a specific product dedicated to this asset class, and that's where we find ourselves today, nearly 3 years after launching.
So let us now talk about the current developments that we have seen during the first quarter, especially when the coronavirus spread worldwide. Have you done a lot of adjustment to your portfolios, or did you sail through these volatile market times?
Well, we have been very active because we've been faced with a huge amount of volatility in the market, which has given us significant opportunity. This is normally a low turnover, long-term investment horizon strategy, and but these are unusual times. We've seen volatility unlike anything we've ever seen in markets, specifically around some of the sectors, which I'll talk about in a moment. And we saw indiscriminate panic selling of equities across all sectors, which gave us the opportunity to make some very important decisions and uncharacteristically add 4 new holdings in the portfolio in a very short period of time. Just to give you the perspective on that, we had gone nearly a year without changing the list of holdings. So again, low turnover, long-term investment horizon, but the volatility in the market gave us a huge opportunity to invest in some businesses in the utility sector around the world to access those stable and growing income streams at a time when the economic backdrop is quite uncertain. We also took the opportunity to reduce certain exposures, such as airports, which is a very challenged area of infrastructure. And perhaps 6 months ago, I would have sat here and said, well, even in a recession, people still need to drive on toll roads. They still need to fly places and use airports and airlines. And of course, for the first time ever, that has not been the case. And so we had to make some adjustments to address that. And those decisions that we made have paid off. And this is where the importance of active investing in this asset class really come to be demonstrated.
Is it possible to say if your portfolio is now positioned more for a V-shaped or U-shaped kind of recovery, or is this something that doesn't really matter for your companies that you have invested in?
No, I have to remember why I'm here and what I'm doing. And I'm investing in high quality asset-backed businesses for the very long term to access those growing cash flow streams. So if I start to try to guess V-shaped, U-shaped, L-shaped, whatever letter of the alphabet, then I'm not doing what I'm meant to do, which is find high quality businesses and own them for the long term as if I am the asset owner. I want to behave as if I am buying these assets and I don't have the opportunity to sell them. I see the liquidity in the equity market just giving me the privilege to adjust and be flexible and take advantage of opportunities rather than something I can use to cover up my mistakes.
When I have a look at the fact sheet of the fund, almost 25% are invested in the energy sector. That sounds like a bold bet when oil prices have briefly been negative. So what's behind those companies?
The allocation to the energy infrastructure space is more like 10 to 20%, and it's currently at about 15. There may be some other like royalties that are classified as energy that add up to that number. But these are not energy producing companies. These are companies that own and control the infrastructure that accommodates the movement and the storage of hydrocarbon products. So they don't have direct exposure to the oil price. Now, their customers certainly do. And so in times of crisis, the equity market will overreact. It did exactly that in March. We've seen this kind of behavior before. We took the opportunity to invest and increase our position sizes in certain places, and we were rewarded quite capably for that in April and May. So again, we're not exposing ourselves directly to energy producers. It's simply the infrastructure. And if you think about, to your point, why the oil price went negative, is because there was no storage. There was nowhere to put it. And people had to pay to have someone take it away. One of the companies we own in our portfolio is an oil storage company, oil tankage company, not tankers, but fixed tankage on land. And they benefited enormously from that situation when everybody was looking to find storage for their products.
At the beginning, we already briefly talked about the defensive characteristic of infrastructure as an asset class. And usually we would expect lower volatility and lower drawdowns. But during this drawdown episode from January to March, your fund and the infrastructure asset class in general lost peak to trough more than the MSCI World. So what went wrong this time?
Well, I think back to my point, we had the most unusual set of circumstances in transportation infrastructure where the entire world locked down and nobody was traveling on roads, on airports, on public transit, on passenger railway. We've never seen that before. The market had never seen that before. And there was a lot of equity value destruction as a result of that. It was overdone, as we saw in subsequent weeks, because those are the companies that have bounced back very quickly. And the other area that was rather difficult in the month of March was energy infrastructure, as I mentioned, because of that sentiment around the energy sector that you highlighted, that drove equity values lower. Again, we've seen that before. It was indiscriminate, it was panic selling, and we took advantage of the opportunity to increase our exposure.
But during the next bear market or drawdown, would you expect a more normal behavior of the asset class?
I would think so, and that's exactly what we've seen in various episodes over the last 3 years. I think we'll all agree the month of March was unusual in so many respects, not just in financial markets, but in our everyday lives, for society. It was an unprecedented set of circumstances, as has been said so many times before. So I would expect that in down markets of a normal type, we would behave exactly as thus. I will point out that one of the characteristics, besides the lower drawdown of this asset class, is its speed of recovery. When these businesses get sold, they are still generating consistent, reliable revenues and cash flows, paying their dividends, growing their dividends. And as a result, the market can't ignore that, and they re-rate very quickly. And that's exactly what has happened in April and May and in June to some of these businesses I've just mentioned. They've been some of the best performers and contributors to our performance since the month of March.
So all in all, you still consider infrastructure and the M&G Global Infrastructure Fund a good long-term solution for an investor portfolio, because it delivers stability and growth and some kind of yield.
Well, my very strong view, as I mentioned earlier, is that if you invest over the long term in high-quality, dividend-growing businesses where we then distribute the income year after year to our unit holders, you will be rewarded by the equity values. And in the nearly 3 years since inception, that's certainly been demonstrated, and I would expect that to be the case over the long term. It's very easy to get caught up in the short-termism and the drama and the headlines of what we're having to live through. But if we keep in mind the long-term structural opportunities around renewable energy, cleaner transportation, the importance of water and recycling, the circular economy, the digital connectivity that we require as a society, I do believe we'll be rewarded over the long term.
Okay, well, fine. Then thank you for your presentation. It gave us a good insight into your infrastructure fund and to your definition of infrastructure. Thank you, Alex.
Many, many thanks for hosting me.